I think that there are a lot of similarities and market patterns between 2008 and the current time period. Greetings, land of Arcadia economics. My name is Dave Kranzler of investmentresearchdynamics.com. I also publish the Mining Stock Journal and Short Seller Journals. And welcome to another episode of my bi-weekly podcast for Arcadia Economics. Before we get started, this episode is sponsored by Silver Viper, as always. Silver Viper is advancing its La Virginia project in Sonora, Mexico, which I know Mexico has been getting knocked lately for jurisdictional risk. Sonora is actually one of the most mining-friendly jurisdictions in the country. You can find it under the tickers VIPRF and VIPR.V, the OTC Bulletin Board and Toronto Venture Exchange, respectively. Now, it currently has a market cap of about 14 million, which I know the juniors have been getting, especially the junior exploration variety, have been getting hammered lately. I do think they're bottoming. You can go into that in a minute. But one thing I did want to point out that I think is interesting, insiders own 23% of the stock. Major shareholders own 57%, and there's a couple actually big investors that I consider they know what they're doing when it comes to investing in mining stocks. And retail owns just 20%. I'm one of the 20%, but the reason why I think that's important is because assuming we get another big bull move in the precious metal sector, and I'll get to that in a second, I think we are. The stock's currently trading at 7 cents US dollars. And I think in the next run that we get, I mean, this stock could easily quadruple, quintuple. Part of it is just because it's silver and retail loves silver, but also the fact that only 20% of the shareholder base is retail suggests to me that it's under-owned by retail. Typically, retail owns 50, 60, 70% of a lot of these micro-cap juniors. And so I think there's potential for a lot of retail money, especially the speculative variety, to flood into this stock. So moving on, what I wanted to talk about today is, does 2023 rhyme with 2008? And I know I've said that on this podcast. I've mentioned it several times in my newsletters, but I think that there are a lot of similarities and market patterns between 2008 and the current time period. And I just wanted to talk about a couple of those. And as with 2008, I am expecting some kind of credit event to appear. Credit event, black swan. I don't even know if it's a black swan. I think if you look for the information, it's pretty well telegraphed. But I think one's percolating, and I think that the regional bank crisis that we had in the spring is an omen of that. I think it's a symptom of bigger underlying problems, and I think it's a good possibility that, we could see everything come to a head and the markets implode this fall. As an aside, it is kind of strange that most of the major stock market crashes have occurred either in September or October. Now, I'm not really sure why. Maybe people get drunk on life in the summer and they ignore the signs. Certainly, there's a lot of speculative money still piling into the crappiest of crap tech stocks, like Carvana. So, but that's an aside. I digress. So one of the things that I'm looking at in terms of the potential for a credit event, a very adverse credit event, to unfold, is that bankruptcies are starting to really rise in corporate loans. And according to this report from Bloomberg, August was the busiest month for bankruptcies on record. And what stood out to me, there's a bigger article associated with this, but I subscribe to Bloomberg News, but not their legal journal or whatever the heck they call it. But 237.6 billion in corporate bonds, dollar denominated in the US, trade at distressed yields. That probably means that most of the companies that are attached to that paper will be filing bankruptcy, in sometime in the future, maybe the near future. I just wanted to show this because you can see that the big spike up in the number of bankruptcy filings is, this is the 4-week moving average, but we're back to where we were in March, I guess the spring of 2020. That was kind of artificially induced bankruptcies, although I think they probably would have happened anyway. And we're almost back to where we were at the peak in 2008, 2009. And I actually think, as I think I've mentioned before on here, I think what's coming at us is going to be much larger in magnitude than 2008. Moving on, the point I wanted to make here is that we're hearing a lot of propaganda, especially in the mainstream media, that the economy is robust, it's doing well. There was an article yesterday that kind of irked me in the Washington Post, and it was talking about the U.S. spending deficit. The government spending deficit is exploding higher despite what it wants to call a robust economy. This kind of bothered me because I'm not sure what economic data they're looking at. They could be looking at the employment report. Certainly, with the unemployment rate below 4%, one might assume that the economy is doing well. Well, if you dissect the unemployment report, you find out that a large portion of those jobs that are created actually magically appear out of thin air from the nefarious birth-death model, or the majority of them are also part-time jobs, not full-time jobs, and a lot of the part-time jobs that are being filled by people who are working 2 or 3 jobs to make ends meet. So the level of employment and how they calculate the unemployment rate and how it's rigged is a conversation for another day. Go to shadowstats.com if you're interested to see how the government does it. But the level of employment in the country is not growing. The level of employment in terms of the amount of people actually working versus not working that are part of the working age population, which I think it's either 17 or 18 to 62, I believe. But anyway, that report from the Washington Post irked me, and I'm questioning how or why the Washington Post is describing the economy as robust, because robust means vibrant, full of life, growing, and that's just not the case. The St. Louis Fed is now projecting negative GDP for the third quarter. We had, up until last quarter, maybe the last 2 quarters, we had 2 quarters in a row of negative GDP. That's supposed to be the definition of a recession. Well, I think we're in a recession and have been in a recession, especially in many sectors of the economy. Manufacturing, factory orders report just yesterday showed that on a year-over-year basis, factory orders are down 0.7%. So that's contraction. That's a major segment of the economy. And that number includes, it's a nominal number, it's nominal dollars is how they report the value of the factory orders. So if you strip out inflation, real factory orders, unit orders are going to be down even more. So, and as the Washington Post points out, usually the spending deficit declines when you have a robust economy. Well, that is evidence alone that the economy is not robust. We've got increasing spending deficit is projected to double to 2 trillion by the end of the fiscal year, which ends this month for the government. And tax receipts are declining. Now, if the economy was growing and was robust, tax receipts would actually be going higher. They're not, they're declining. So much for that. Now, the reason I bring this up is that, again, I think the current period that we're in is very similar to how 2008 unfolded. And it's not going to be exactly like it. I mean, that's silly to think that. But there's some market patterns, particularly in the way gold is trading and the way the stock market is trading, that are, again, they're not repetitive with 2008, but they're similar. And so I wanted to just take a look at a couple charts here. This is gold on a weekly basis from 2001 to present. In the past, I've discussed the massive cup and handle formation here. And I just wanted to, again, and this may be a bit of a stretch, and charts can only take you so far in trying to figure out what's going to happen next. But I cut and paste a copy of late 2007 to mid 2009, and I wanted to kind of put it next to what the current trading pattern in gold looks like. And you can see it's similar. And again, it's not an analog chart. It's not on the same timeline, but it's a similar chart formation. And from here, from mid 2009, we had a big rally here. We had a big move higher that lasted close to 3 years. And I think we're probably on the cusp of that again. And one of the things that I wanted to look at is that back in that period, say just 2008 to 2009, the S&P 500 and gold were tracking pretty closely as the economy got worse, as the great financial crisis came to a head. And they were both pushed down throughout the summer and into the early fall. And out of nowhere, and again, the Fed announced that it was going to start printing money, and gold took off. It dislocated positively from the stock market. The stock market kept going down until mid-March 2009. And part of that is because it takes a while for printed money. When the Fed prints money or creates reserves, whatever you want to say, there's nitpickers out there that they're not printing money, they're creating reserves. Well, technically that's correct, but that's how money gets transmitted into the financial markets and into the real economy. So in a sense, the credit creation enables the fake creation of money, because credit spends. Credit is the same thing as spending money until you have to pay it back. Well, guess what? We never seem to want to pay it back in this country. At any rate, so this is what I think it's probably gonna look like this time, somewhat similar. There's some of the characteristics, like right now, and part of the reason why I thought about this is a handful of my subscribers have emailed me over the last couple of weeks, and they're really getting bummed out and agitated about the performance in the mining stocks, and especially the junior exploration variety. And so I started looking, if you look at it, what they're doing right now, and the reason why the stocks aren't performing well is gold's getting pushed lower, silver's getting pushed lower. And that's what happened right ahead of the blow up of Lehman. It took the blow up of Lehman for that to happen. The blow up of Bear Stearns, Wash Mutual, Wachovia, etc. It didn't get gold ignited, but it should have. But that's because it was being artificially pushed lower. And I think that's what we're seeing now. And most of the price decline that we've been seeing over the course of the summer, when gold has declined and silver, has occurred after the Asian and Eastern Hemisphere physical gold trading markets close, and London, the paper markets in London and New York take control. So at some point, I think that they're going to they're not going to be able to push it down any longer. And unless the Fed has a motivated reason, or I should say the powers that be, it's not just the Fed. Unless the powers that be have some motivated reason for why they want to let the system fall apart and collapse, the Fed's going to have to at some point announce a big money printing program, credit creation program at some point. And I don't know when that's going to come. No one does. I don't even know if the Fed does yet, or maybe they do. This all could be planned. There's another chart I wanted to put up. Gold versus the S&P 500. And this goes from the beginning of 2020 to present. What I wanted to just show here is that similar to both markets tracking pretty closely in 2008 in terms of their directional movement, the same thing has been happening from the beginning of 2022 to now. And a big part of that is both of these markets are ebbing and flowing on the idea that the Fed's going to pivot, that easy money is going to come back. And at some point, maybe it will. But the fact that, the market like moves like this on every breath of Powell or every breath of breathed by, regional Fed bank presidents who come out and say that, maybe we can pause at the next meeting or whatever. Some people agonize over every word and punctuation mark. And it's just utterly ridiculous. But anyway, at some point, it's not going to matter for gold because the market's going to see what's going on. And at some point, there's going to be a flood into gold, silver, mining stocks. And I think we may be getting close to that. Again, no one knows. Anyone who says they know how to figure that out, what's going to happen tomorrow, what's going to happen next week, what's going to happen next month, they're kidding themselves, or they're just outright lying for some reason. But I will say there are some indicators, and the last chart I wanted to show was the gold miners bullish percentage index, and I'm sure most of you are familiar with this. It can be accurate. It's a good contrarian indicator. It's based on some formulation of point and figure charts, but essentially it shows periods of time when the market's technically oversold or undersold. Currently, the miners are pretty technically oversold. And the reason why I wanted to show this chart is it's at a level now where we've seen the precious metals sector take off in the past. And some of the rallies in the past have been big rallies that sustained for several months. And some of them were kind of, short-lived. So for instance, here's what this indicator looked like toward the end of 2015. And the sector bottomed in December that year. It actually went sideways for a few months and then took off at the end of December, early January, and rallied for the next 7.5 months. And the ones where I circle in green is where we had, somewhat sustainable rally. The yellow circles are where the miners were oversold and the rallies were more short-lived and not as strong. So that's what happened at the end of 2016. The market started selling off in August. Precious metal sector started selling off in August that year. And it had kind of a technical bounce at the end of the year and into early 2017. But here's 2020. Everyone knows what happened then. I'm sorry if you don't remember what happened. It may start happening again for all we know. It's what they're trying to do. But anyway, that rally wasn't as good as the one in 2016, but it was sharp and it lasted 5 months. And then we had a bounce at the end of 2022. You see the market's oversold. We're oversold again. And I don't know what kind of bounce is coming. I think a bounce is coming. I don't know what black swan might show up to make it happen. I don't know if anything will show up to make it happen. Maybe all the markets are going to keep going south from here on out. I don't know. But just to circle back again, I think unless the Fed plans, the powers that be plan on have something planned that's going to be really, really unpleasant, and they don't care about keeping the system from falling apart. I think maybe this fall, certainly within the next 6 to 12 months, our system's going to fall apart. There's going to be a credit event. The precious metal sector may not be done going lower. But on the other hand, I think now is as good a time as any, if you're underexposed or not exposed, to start building positions, start taking positions and get ready for it. There's a lot of analogies that I'm not fond of. And one of them is with regard to why buy gold or why buy gold now. And the answer is, well, you can't buy insurance once your house is on fire. And, it's a trite analogy, but I think it's also appropriate. So one last thing I wanted to mention is my next issue of the Mining Stock Journal will be released after the stock market closes. And I've got updates on several of the mining stocks that I cover. And I think there's some pretty good ideas. There's a few that are particularly cheap. One just had some news out today. And this stock, I think, has over the next 2 or 3 years the potential to be a 7 or 8 bagger minimally. So with that, until next time, don't spend too much time in front of the computer watching your mining stocks and the price of gold and silver all day long. I don't know how long it's going to be before things get ugly, but go out and enjoy the end of summer weather, and always enjoy what you can while you can for as long as you can. Until next time.